Okay, so I'm going to give you an idea of what annuities are. This is going to give you a broad overview of what an annuity is, how it functions, who's involved, how they pay out, how people can pay into them, what happens when the money's paid into them, things like that. So an annuity is basically a cash accumulation vessel, and it provides income for life or for a specific number of years. Now, the purpose of an annuity is to take a large sum of money and distribute it in payments over a specific period of time or for someone's entire life. So a lot of times it's used in retirement accounts. You may take your retirement account, you put it into an annuity, and then you can get the money like for the rest of your life so you don't outlive it. Or say someone has a ton of money and they want to leave their grandchildren some money, but they don't want to leave them like a ton of money at once. They can leave the money in an annuity, and then they can have that money paid out in payments over time so that the grandkids don't just go like spend it all at once. There are many different ways. Bottom line is it's meant to take a large sum of money and spread it out in income payments over time. Now, you may wonder, hey, why would someone not just keep it in their bank account? Well, someone may not want to have access to all that money. And then also the money in an annuity can grow tax deferred. So it can grow. There's some tax benefits to an annuity. You put the money in, the interest accumulates tax deferred, so you don't pay interest on the growth every year. So annuities are marketed by life insurance companies and sold by life insurance agents. So if you're getting your life insurance license or your life and health insurance license, then you will be able to have you'll have the ability to sell annuities if you want to, and if they're offered by the carriers that you work with. So annuities are typically, from what I've seen, you mainly try to sell annuities towards someone who's like in retirement or gearing towards retirement. But what I'm going to go over here is like the basics of what you'll need to know for your life insurance license exam. Okay. So this is like some overview of what you'll need to know for your license exam. Now, there are three parties involved in an annuity. There is the owner, there's the annuitant, and there's the beneficiary. The owner can be a corporation, a trust, or a person. And the owner, it can be an entity. The owner is whoever pays into the annuity and owns the annuity, right? They can make the decisions on it. The annuitant is the person who receives the income payments. Now, the income payments really depend on how long the annuitant is going to receive the payments for and how long they're expected to live, okay? Now, also there's a beneficiary. So the beneficiary for the annuity is the person who would receive the assets of the annuity, if there's cash value or any value in the annuity left over, if the annuitant dies prematurely. Okay, so the beneficiary is one who can receive any of the money that's in there if that's an option in that annuity. What you're going to see is it's usually easier to understand these concepts if you illustrate them. So I'm going to put an image right here that just shows how there's an owner that owns the annuity who pays into it, and then there is the annuity. The money can either start paying right away to the annuitant, or it can accumulate more value and grow with interest. But eventually it does pay out to the annuitant where they receive a stream of income payments. Now, the pay-in period, the time where the owner is paying into the annuity and what they call premiums, is called the accumulation period or the pay-in period. Now, they can pay into the annuity in one lump sum, or they can pay in premiums over time, where they'll have periodic premiums. So they'll pay annually or monthly or whatever it may be. Now, you're also going to find that some periodic payments can be flexible. So some annuities allow for the owner to pay in more money 1 month or in one payment period and less money in another. So it's important for your life insurance license exam to know that you are going to, during the in the accumulation period is when money is paid in. In the annuitization period, that's when money is distributed out to the annuitant. The annuitant is the person who receives the money from the annuity once it starts making income payment. There are 4 things that an annuity income amount is based on. Number 1, we have the age of the annuitant, and then number 2, we have the amount of, and then we have the interest rate that the money is growing within the annuity. So there's the age and gender, there's how frequent the payments are paid out, there's the interest rate, and then there is the amount of premium paid in or cash value accumulated in the annuity. If it's a lifetime income annuity, meaning they're going to receive income for life, then the person receiving the money, if they're younger, right, then the payment's going to be smaller for the annuity because they have more time to receive that money. So say someone's 40 and the annuity's got $1 million in it, and they're 40 years old. They're like, I want to start receiving this money right now. Then it's going to take longer for them to receive those payments of $1 million. So it's going to be, they have more time to spread that $1 million out. So the payment's going to be less every month than it would be if the person was 75, right? Because the 40-year-old's going to live longer than the person who's 75. So the person who's 75, the insurance company may say, well, they're expected to live till they're like 87. So we're going to pay out that $1 million over that time period, or whatever the cash accumulated is and whatever their calculations are. So bottom line, the younger someone is, for most annuities, the lower the payment's going to be, especially if it's a lifetime income annuity where they're going to get income for their life. Annuities are typically purchased for retirement funding. So like I said, say someone retires with their 401k and there's $2 million in it. And they don't want to have all that money sitting there, and also they want to roll it over into something that can keep growing tax deferred. They can roll it over into an annuity, right? The money can keep growing tax deferred, and they can pay tax on the annuity payments. It can be taxed as income, but they're not going to have that big chunk of money to access, and then the money's also not going to be like subject to market volatility if they put it in a fixed annuity, which we'll get into the types of annuities in a minute here: fixed, indexed, and variable. But usually they are marketed for retirement funding. So you'll see a lot of financial advisors try to go after people who are, for clients that are nearing retirement age, because they're like, hey, this person may have some money from retirement that they want to roll into an annuity. And also too, it can be used for like college funding. So say they like put a bunch of money into an annuity and they tell the college like, hey, we're going to pay you, like parents can do this, or grandparents. They put a bunch of money into an annuity and they say, hey, every month or every year, this is going to spit some money out to the college to help pay for the college. It can be used to liquidate an estate, like I said before, for inheritance. It can also be like a structured settlement or something, or like lottery winnings. Like say someone, how if someone wins a lottery, they can choose a lump sum or to receive income payments over a certain period of time. If someone chooses to receive the income payments for a certain period of time, what happens is that the lottery winnings get put into an annuity, and then the income is received. The annuity pays out the lottery winnings over time through an annuity. And people hope that over time, eventually, if it's an annuity, they'll end up getting more money paid out to them than if they, if they were just going to disperse it to themselves, and more money than that's in there. The hope is that over time they'll get more money than what's put in, right? So there are different types of annuities. They're classified one way on the premium payment method. So how is the payment paid in? Well, they can be paid in single premium or periodic premium. So single is like one payment, and then it's the cash can either sit there and accumulate or start paying out to the annuitant right away. An example of that is, like I said, a 401k rollover, where if someone has a 401k or their IRA when they retire, their retirement account, one single premium payment into an annuity, and then that funds the whole annuity. And then there's a periodic payment as well. So sometimes when people are younger, they will want to start putting money into an annuity for retirement early. So say someone's like 45 or 50 and they say, hey, I'm going to start putting some money into an annuity. Then they can put it into that in periodic payments. So that's a periodic payment type. So know that for your exam, you're going to want to know that there's two premium payment types. You're also going to want to know that there are two types of payment options in terms of immediate or deferred. So there's going to be an immediate annuity, which the payments start within 1 year of the money going into the annuity. So say the retirement account example, right? Guy takes his 401k, he puts it right into the annuity and wants income payments within the first year, then that's going to be an immediate annuity. That's going to be a single premium immediate annuity. And if it's a single premium deferred annuity, then what happens with that? Same example. Say the guy retires with his 401k and he says, I want to keep the money growing for another 5 years though before I receive income payments. That would be deferred. So he's deferring the income till later. So he says, we're going to put the money in here. It's going to sit here for 5 years and grow. And then we're going to start receiving income payments from it. So there's also fixed and variable annuities. So this is how the interest rate grows within the cash accumulation. So fixed is when the insurance carrier takes the responsibility of the investments in their general account. So the insurance company says, we are going to take all the investment risk. We're going to guarantee you a minimum level of interest. And then and that's what it's going to be. You're going to get a guaranteed interest, guaranteed payments. The payments are always going to be the same. You know exactly what they're going to be every time. And then there are variable annuities, which are invested directly into mutual funds and variable products, which you actually need a Series 6 in 63 to sell. You can't just go sell variable annuities with your life insurance license. So variable annuities, the money goes in, say the same example with a 401k, which this isn't good suitability, which you're going to learn about, meaning you shouldn't, like most people retiring wouldn't want to put their money in a variable product because of potential market loss. But say the guy wanted to do it, because they can do it if they want to. He takes the money in the annuity, puts the money in a variable annuity, and then that value of the money fluctuates with the stock market essentially. Okay, the amount of money that he's going to get every month will vary based on how the stock market is performing at the time. So there are a few different ways of disposing the proceeds. There is a pure life where someone will get money for the lifetime of the annuity, and depending on what they select as a settlement option, they may have a beneficiary who receives money or may not. They may take the risk that they're going to lose the money in there if they die prematurely. There's also annuity certain, which is when there's a certain period of time that the money is paid out in, where in the life refund annuity, if the annuitant dies prematurely, then their beneficiary will receive whatever difference there is in benefit between what the annuitant has received from the cash value that's been accumulated and what's in there, and then what's paid out essentially. So if there's any remaining money, then if it's a life refund annuity, then they can get some of that money back. The beneficiary can. So in a variable annuity, what happens is the owner pays in and purchases what are called accumulation units. Okay, so accumulation units build up within the annuity, and then it's like buying shares in a mutual fund, kind of, right? And then when they retire, when they want the income to start paying out in the annuity, the accumulation units convert to annuity units, and then the annuity units that pay out, the amount of money that's paid out in each annuity unit is contingent upon the value of the market at that time. So the amount of annuity units is the same, but the amount of money that each annuity unit pays out depends on the how the market's performing at that time. And then there's indexed annuities. So indexed annuities are invested in indexes like the S&P 500 or something. Typically it's in the S&P 500, which is an index of equities, meaning it's an index in the stock market that shows how well the United States' economy is flourishing or functioning pretty much. So the S&P 500 index annuities, how it works is there's typically a minimum amount of interest that the insurance company says that the account will earn, but then there's some more upside to it. So in a variable annuity, there is no minimum. So they could essentially lose money, right, if the market tanks. In a fixed annuity, there's a guaranteed interest rate, and that's what it's going to be. It's not going to go up. It's not going to go down. And in an indexed annuity, there is a floor minimum interest rate, which is typically lower than the guaranteed interest rate in a fixed annuity. But they do have a higher, so there's like a protection against loss, but typically there's a higher amount of earning potential. So example, right? Say it's an indexed annuity, and the insurance company says, okay, well, depending on how the S&P performs, we are going to take the first 4% interest out of it, and then you can get anything over that. So say like the market performs at 10% interest that year, the S&P 500. That means that the insurance company is going to get 4% of the interest on the annuity, and the annuity is going to receive the other 6% of that 10%. So that's how indexed annuities work. So you got to understand that annuities are classified in a few different ways. They're basically just cash accumulation vehicles. They're based on when payments start. So it's either immediate, the payments start within the first year, or deferred. The payments start over 12 months or after year one. It's based on, they can be classified based on how the money is paid in. So is it paid in one lump sum, or is it made in periodic payments? They can be classified on payment amounts that are paid out. So is it going to be for the person's whole life, or is there a guaranteed minimum amount that they're going to receive, or do they want it paid for a certain amount of time? It also depends on how many lives are covered. So there can be one person, or there can be a husband and wife covered, like joint or joint survivor, kind of like in life insurance. So you can have one person covered, they die, that's it. Or you can have like the husband covered, and if he dies, his wife will start receiving the benefit. It will get anything that's left over as a benefit. Or you can have it so like both people will receive the payments of the annuity. And then it's classified on the underlying investment. So is it fixed or variable, right? And it can also be an index as well. So I hope this helped. In the next video, I'm going to be going a little bit more in depth into annuities so you can learn a little bit more about them. But this just kind of gives you a broad overview of what they are. What the main thing that you want to know is that money goes into the annuity, it accumulates value, and then it pays out in income streams. So it's a way to distribute large sums of money. And it's based on the reason why life insurance companies sell it is because the amount of money that's paid out is typically based on the age of the person receiving the money, okay?